I used to be the person that would tell you what your worth is. And I'm going to showcase what companies like Meta and Microsoft are really seeing when they're trying to eliminate headcount. All right, so let's just draw an iceberg. For Meta and Microsoft, the average salary, let's just say it's $250,000. You see this. The company sees a 401k. They see a healthcare benefits, recruiting fees, and just these two, the benefits and healthcare, it's about on average 20%. That's what we calculate at GE and Moen. That was about that. So automatically, just with that, it's 300k. On top of that, now we're looking at the recruiting fee. It's for higher tier companies. It ends up being, about 20% too. So now overall, we're looking at 350k. And then there's also bonus, all in, to be conservative, 400k. There was 7,000 layoffs, all right? So 400k. But let's just keep it conservative to easy math. 400k times 1,000. That's $400 million that the company is saving on margins. And that is exactly what your technical worth is on a spreadsheet, increasing margins. And as a shareholder and used to being in the boardroom with leadership, this is what you are constituted as. A number on a spreadsheet that they don't care about. And to say, hey, we can cut senior leadership, we can save those margins. Hey, we can maybe, go out instead of having one senior director, we can just have maybe one junior and then an AI agent. That is what your worth is. A smart person and thinking about plan Bs. No matter what you are in, you should find something. And this is the part of something. I have found trading, and we are going to be going over the SPY macro and some of our team's trades of our 1,200 plus professionals and are exactly like what we're seeing and why we're in this state of, it sounds like euphoria, but we are nowhere near .com levels. But I'm going to showcase the markets and our trades and what we're looking for. The SPY has had quite an insane recovery, and I'm going to showcase, and let's just get started. The SPY closed as of Friday, May 8th. We have had the fastest recovery in actual history, just straight up like weeks of green, and we have gone up 16.8% since the low. There's a few things that should be, red flagging for anyone. We're literally going up every single day, barely even consolidating. Other thing too, if we take this back, like just looking at this on the daily time frame, the volume is kind of mediocre. And off the weekly, you can showcase, like right now it's about average, and this week's a little bit stronger, but the Bollinger Bands are expanding, yes, but the move is very overblown right now. Other thing too is also, I don't reference these that much because if you're a true trader, indicators you look at them as like a nice extra. Indicators, they are actually touching. And other thing too is you notice we're touching, so we're kind of at like a judgment day. You'll notice we're having like a little bit of a bearish divergence. We're making new highs, but they're flat and they're kind of starting to tip down. Bearish divergence right there. So that should kind of get your blinders up. Another interesting fact that I think this is pretty interesting. I know, if I go on to LinkedIn, right? If we go on to LinkedIn and you start looking and you're looking like, job market. No, it's actually pretty awful if you actually really look. Majority of this feeds, it's funny. If you look at your cell phone, it's actually 10 times worse. People odd advertising, and then there's some like about layoffs and so forth. But these are just some interesting stats. The higher you up that you move on the corporate ladder, the actual worse it is. Service occupations are 25.1 weeks being unemployed. Professional related 6 months. Management and finance 33, so 7.5 months of being unemployed. That should actually freak everyone out because most people do not have those kind of savings to sustain themselves. And it's also going to show you too, the job market and the stock market are actually very interesting parallels because the stock market is making new highs, and that is a definite reality that we're seeing. Also, if you want to work with me, link below. Another trade that actually our wonderful coach Elliot called out was GIS, and he entered on Tuesday, May 5th, and it was a perfect bounce case. What did we do? We bounced, we swept below, killed everyone's stop losses, long liquidity sweep up with above average volume, and the price target was around 35.85, and we saw, and I'm glad that he came out yesterday, Thursday, because we had a very large rejection. But this is also something to know. This was a fantastic find, as well as it literally kills every single setup that we wanted. Has the liquidity sweep, long lower wick, above average volume. We have a definitive move. A lot of times if you've been looking at my videos, the setup is the same because we have trained our eyes for this setup. Something to also know, and this is just kind of interesting regarding sector rotation. We all know XLK and big tech has been just on an absolute terror. I mean, AMD, if you bought AMD last year, you would be looking at over 200% returns. I actually own shares of AMD, so I'm looking on just shares alone over 200. I think now I just looked with like 240% returns. And obviously we can see XLK just absolute terror because of the earnings that's been occurring. But one thing that I am watching as sector rotation occurs, XLP is consumer staples. And that's very defensive in nature. Yes, we had a big dump, but look at this. Signs of accumulation. It's moving up and grinding higher. And GIS, General Mills, is part of that. And we're showing signs of like several weeks of just sideways action. Usually signs when there is accumulation occurring, especially in consumer staples. It's very defensive in nature. And really we should look at the overall performance. Obviously we know big tech is leading the way right now, but volume is kind of peaking a little bit. Their performance overall, like obviously things are being dumping, but consumer staples, it's a telltale sign. I would be watching that, especially now we have a bearish divergence. A lot of things occurring. Also, another trade that we're looking at is Amgen. Healthcare has kind of died, but all of a sudden we have a lot of buyers here. Strong hammer candle with a lot of buyers. It's almost brushing the lower Bollinger Band, not yet, but we're at a very strong level of support. We have a strong hammer closing previously higher than the previous week. And just basically, this kind of move, I would not be chasing this. I mean, this is insanity. As much as I love it for my portfolio, I would not be chasing this. And you have to think, if you're thinking like Wall Street institutions, eventually the order flow will go from like what has been undervalued and beaten to a pulp, and where can Wall Street park their money. The biggest thing that's waiting on the chopping block right now is Nvidia has earnings in 2 weeks. But majority of the big players have already had their earnings. Now the biggest thing is where are they parking their money? Healthcare has really died. And so why are you seeing stocks like Amgen, another one, GEHC, GE Healthcare Technology. If you're looking at that, that's also showing signs of life. Eventually, stocks that have died are going to see light at the end of the tunnel. We're seeing that like healthcare looks like it's kind of rotating. A lot of healthcare stocks are showing signs of life. At the end of the day, you want to have your plan B. I used to be the person that actually did the spreadsheets and say, hey, you are worth, and I'm going to cut you out for 200,000, and actually have to tell them in secret because I had to, since I worked at the company, and say like, oh, this person's actually strategically worthy to be cut because they're too expensive. Now I ask you, for everyone who's feeling this, what are you planning to do? If you want to join our 1,200 plus professionals and find a plan B, link below. I'll see you guys in the next one.